Good morning and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, March 10th, 2020. Wow. Heading into hopefully what will be a more bullish historical period. For those of you who do follow me from a historical perspective, the 26th to the 6th of the calendar month tends to be strong, 7th to the 10th, not so much. And then we go into another period, 11th to the 18th, where the market tends to do well. And this market certainly could use a little bit of a rebound at this point. But let's go over some of the things that we are going to talk about today. We've got, of course, the daily market recap that I start with every day. Talking technically, there's been a lot of comparisons between 2020 and the fear and the big drop that we've had, and comparing to what we had back in 2008. I'm going to do my best to dispel that comparison because I don't think it's anything like what we saw back in 2008. I'll talk about that during talking technically. Sentiment, that's a big thing to watch. When the market gets fearful, a lot of times I throw out the support levels. When you've got a VIX that's rising into the 30s, 40s, 50s, and yesterday moving into the low 60s, support levels, technical things, pretty much you just toss out the window. And I'm a technician, but it's almost like a hot knife going through butter when you hit a key support level with a VIX at 60. It's like the support's not even there a lot of times. So we need to turn our attention to sentiment, because extreme sentiment a lot of times will mark key bottoms in the market. So I want to talk a little bit about sentiment today. Then we'll get into the earnings spotlight. Not a whole lot going on there. Things are quieting down. We start up with a lot more earnings in about 5 weeks, middle of April. Until then, we'll just have a couple of big reports sporadically and a few smaller ones mixed in. But we got a couple we'll talk about. Upgrades and downgrades. The market always seeing a lot of upgrades and downgrades. We'll take a look at a few of those. And then we'll wrap up the show with 3 you must see. And I'll give you a little hint here on the 3 you must see. There's an indicator. Talked about this with Earnings Beats members yesterday. But there is a technical indicator that I think is worth watching when you get into an environment like this where you're seeing all these gaps. Because a lot of these gaps are to the downside, and it really masks a lot of times some strength of some companies. So I'm going to talk a little bit later about the accumulation distribution indicator and how you can use that, I think, to your advantage to help evaluate some stocks. So that will be in the 3 you must see at the end of the show. But let's go ahead and get going and jump into the daily market recap. It was an ugly day. And it was an ugly day mostly from the start, not necessarily throughout the day. We did weaken again into the close, but I want you to take a look at these numbers first. Okay, the Dow Jones down 2,000 points. Sorry, I can't mask that. It was a bad day. But we were down 2,000 at the open. So once again, it was the big gap down, and then there really wasn't a whole lot of follow through to the downside. The S&P 500 down 225 points. The NASDAQ down 625 points. And this is the candle where you can really see what happened. We opened at the low. We rallied in the middle of the day or during the day, and then came back down at the close, back down near the lows of the day. But it is a doji. It's off of a downtrend. I wouldn't be surprised. I said last night when I was talking to our members, I actually bought yesterday morning at the open because there were some just extreme sentiment readings that I'll talk about in a little bit. And I'm just looking for a short-term bounce. It's not, maybe we go straight back up and all the selling's behind us. But I do think in the short term, we're at least going to attempt to rally here, and then we'll see how this develops over the course of the next couple of days. The mid caps hammered to the downside, 9%, more than we saw on the other major indices. Same goes for the small caps, almost 10%. So the underperformance in mid caps and small caps continues. Doesn't seem to matter if the market's going up or if it's going down. These two areas of the market continue to underperform. Some of that is because of energy and financials, especially energy. A lot of energy companies in the mid cap, small cap index, and you can see energy just absolutely trounced yesterday with crude oil prices having its worst day in 29 years. We haven't seen a drop percentage-wise on crude oil prices like yesterday since 1991. So energy down 20%, the XLE down 20% on the day. $8.56, closed below $34. You can see clearly we were already in breakdown mode, and that just added to it. Financials, also a very rough day, down more than 10%, and that is directly attributable to the huge drop we're seeing in Treasury yields right now. So as the 10-year Treasury yield continues to tumble, financials getting hit harder than other areas, many other areas in the market. Materials, also bad day. Industrials, technology, all 11 sectors were down. A couple of the defensive groups did better on a relative basis, which is typical when the market is down. Usually your aggressive groups are going to get hit the hardest. But I would look at energy and materials, and I don't really throw those in as aggressive groups. Those are kind of, I have aggressive, I have defense, and then I have other. And so energy and materials to me is other. I think there are a lot of things that impact these two groups, especially the direction of the dollar. But in the case of energy, I mean, when crude oil is dropping like it was yesterday, there's really not a whole lot of defense for that group. All right, let's move on to the 10-year Treasury yield. Let's talk about this a little bit. First of all, there's really nothing out today in terms of economic news. So the market is just trading back and forth on the fear, the anxiety, and maybe a little bit on technicals. Like I said, technicals aren't really in play here, except obviously I think everyone knows we're very, very over sold to the downside. The 10-year Treasury yield right now is at 0.62%. A week ago, I wouldn't have believed that, but this is actually a big bounce. We're actually up 13 basis points today from 0.49% at the close yesterday. So it's nice to see the 10-year Treasury yield moving up, because that means money's rotating out of Treasuries, even if it's just temporarily. That should give the market some relief. And currently, the market is doing pretty well in pre-market. We do see the Dow Jones, currently the futures are up 840 points. The S&P almost 100, and the NASDAQ close to 300. And most of the global markets have rebounded pretty nicely today as well. I would say most of the global indices have rallied in the neighborhood of 1 to 3% overnight and or this morning. And it looks like the U.S. is going to open up just above that, just above 3% based on where we are right now. That could change in the next 22 minutes, as we know. But at least for now, it looks like we're going to get some relief, and that 10-year Treasury yield moving higher is a good part of that. One other thing with the Treasury yields is I like to look at the 10-year versus the 2-year. So it's that spread. And of course, a lot of technicians look at this, and when that yield spread goes negative, that's, that can be a problem and sometimes leads to a recession. So as, we're watching the market unfold here over the next, several days, several weeks, I would keep a close eye on this, the 10-year versus the 2-year, because there are a lot of folks now saying that, hey, this could turn into a recession in the near term. And recessions, by the way, have happened many times during secular bull markets. I still believe we are in a secular bull market. I believe the stock market's going higher. I think we're seeing a lot of manipulation. I'll get into that in a minute. But, like I said, it wouldn't be out of the ordinary to have a recession in a secular bull market. We saw several in the 1950s through the 1960s. I think there were 4 or 5 recessions during that entire secular bull market. In the 80s and 90s, I think we had a couple. I know 1991, I think maybe 98 maybe. No, I think it was just 91. And maybe, I don't even think during the crash we ended up having a recession. So it might have just been one. I can't remember if there was 1 or 2. But my point is, you can have recessions. You can have cyclical bear markets going down 20% within the confines of a long-term secular bull market. And I think history is going to look at this as a cyclical bear market within the confines of a long-term secular bull. I could be wrong. That's my opinion. All right. I want to talk now about, I want to get into talking technically. I want to tell you a little bit about why I think this market has been manipulated. I mentioned this last night in a special webinar to our Earnings Beats members. And so I want to just show you. So bear with me while I bring up, it's an Excel spreadsheet. I'm a numbers geek. Sorry, bear with me. But what I did in 2008, this is the spider. And this is where the spider was trading back in 2008, October 1st. It had closed at 116.06. On October 2nd, Thursday, and this is when the financial crisis really took hold, we gapped down to 114.95. So this was the open on the 13th. So you can see we had an opening gap here, down $1.11. Then by the close, we went to 111.85. So we actually lost another $3.10 during the day. October 3rd, and I'm not going to read all these off. I just want for you to see how this spreadsheet's set up. So on the 3rd, we open at 112.86 versus that prior close 111.85. So we had a gap up of $1.01, and then we sold off $2.52. And so I went through this whole process. There are 11 trading days here. From the, we got 2nd, 3rd, 6th, 7th, 8th, 9th, 10th, 13th, 14th, 15th, and 16th. And what these 11 days represent is starting at this 116.06. Now, we were already in a downtrend. We were already in the bear market. But this is when the massive selling began, from 116.06. We went down to a close of 86 and change. I think intraday that day it got as low as like 83 and change. But we went to 86. The very next day we hit we closed at 101. I'm not sure what the intraday high was, but you can see how rapidly we bounced. And then literally 3 days later, you can see 93 and 91. 91 was the open, 93 was the close. But intraday, we got down, I think, to 88 and change. So we went back and effectively got close to a double bottom. So we went down, we bounced, and then we went down again over these 11 days. Now, what I want you to focus on is the makeup of this selling. So from October 1st, 2008 to October 16th, 2008, we saw the spider drop from 116.06 to 93.77. By the way, this percentage, I should have corrected this. I forgot. It was wrong in my webinar last night. This was the calculation of the decline. It's actually 19. I think it's 19.21%. So disregard the 37.68. This $22 drop from 116 to 93 was about a 19% drop, 19.2%. The opening gaps, if you take all of these opening gaps and add them up, we actually, during this period of 11 days, opened higher a net amount of $2.13. And all of the losses incurred back then were during the trading day, from 9:30 in the morning to 4 o'clock Eastern. During the trading day is when all the selling occurred. And if you think about how distribution works, if you're an institution, you need to get rid of a lot of shares. They don't generally put an open order, a market order in at the open. They're going to have to try to sell during the day when there's volume. I mean, you're not going to trade in after hours if you're trying to get rid of millions of shares of stocks. So I could look back at 2008 and I could see where all of the selling was taking place during the day. And there was a lot of distribution that took place back then. That was true fear and panic. And so you can see that the selling, due to the gaps, we actually gapped higher. So there wasn't any selling as a result of net gaps. All of the selling was intraday. So keep that in mind, because now I'm going to show you 2020. And yes, I do believe markets are manipulated. Anytime you have market makers who are in business to trade stocks to make money, they're going to use whatever they can to their advantage to make money. That's within, that's legal. And it's legal. We can't say where everything's going to open. We have to make our decisions whether to buy or sell based on what's happening in the market. Now, in 2020, I want you to look at some of the similarities. First of all, from 333 down to 274, this is the spider from the February 21st close, which was options expiration Friday, 2 weeks ago, a little over 2 weeks ago, to yesterday's close at 274.33. We dropped $59 on the spider. 17.74%, so almost as much as we did in 2008. Pretty interesting. I mean, numbers are pretty close. We also had a drop to 288. We had a rise to 312 and another drop. Now, in this case, we went a little bit lower on the second drop. So we did go below the prior low, but, just one day, and it was all at the open. But when you look at this, we went down, we went up, we went back down. We dropped 17.75%, pretty close to that 19%. The makeup of this selling, though, is completely different. And this is where I have problems with those who are saying that this is just mass exodus, institutions are out, big bear market coming. It's not acting like it to me. Look at the gaps. Remember, the last crisis, 2008, we actually had net gaps that were up $2. And all of the selling took place during regular market hours. Here, we've dropped 17.75%, and 90% of it has occurred at the opening bell. Think about that for a minute. 90% of the selling has occurred at the opening bell. 10% has been during the day. $5.90 of this, 333.48, has been selling during the day. $53 of it has been the effect of scaring everybody with all of the media blitz and the quote unquote information that we're being, that's being shared with us. I don't know how to interpret this other than manipulation. I mean, if somebody's got an idea, I asked members last night at Earnings Beats, send me an email, tom@earningsbeats.com. I would love to hear from you. If you have a way of explaining to me how institutions are easily getting out in this environment, because they can't sell in after hours. Are they putting in market orders at the open? Are institutions putting the market orders in at the open? And then who's buying? There's buying. There's actual, a lot of these days, the market's going up from the open. I don't know. Just seems really strange to me. So I'm just throwing it out there. Do with it what you want. You may not care. Hey, if you're looking at your portfolio, it doesn't matter 2008 versus 2020. One, you're down 19% in your portfolio. The other one, you're down 17%. You can't go back to your broker and say, hey, this is rigged. It's all gap downs. Give me my money back. That's not going to happen. But my point is, I see a big difference between what has gone on here in this panic and what we had back in 2008. I remember 2008. And I remember wondering if I needed to put my cash under my mattress because I didn't know if my bank was going to make it. That was completely different than the fear I'm feeling today. And I don't know if everyone else feels the same or not, or whether maybe you weren't invested back in 2008. But I can tell you that was the scariest time in my entire investing career. And I, started investing had been in, but I was really shaken by that 1987 market crash. Of course, 25% in one day will do that to you. But, this has been a pretty steep drop, just like the one in 2008. But to me, it's been a lot different. All right, let's move on. I want to talk a little bit about sentiment. So let me get my charts back up here for you. All right, so let's move on to sentiment. Because when we get into a really volatile market like the one we're in right now, as I've said, technical analysis, I'm a huge fan. And you're talking to somebody who's a fundamentalist at heart. I was in public accounting, passed the CPA exam almost 30 years ago, dating myself. But, and I was in public accounting for 20 years. I was a principal in a big firm in DC area. I know fundamentals and I respect fundamentals, but 99.999% of the time, just give me my charts and I'm good. Well, that other 0.0001% of the time where the charts, the technical analysis, the price supports, the trend lines, and all of that, I sometimes just kind of throw out is when we see a volatility index up in the 50s and 60s. When we're talking about that kind of fear and that kind of volatility, we don't even know what we're going to wake up to. We woke up yesterday to 2,000 points down on the Dow Jones. Today, last time I looked anyway, maybe I should get a quick update, see where we are. Right now, we've got the Dow Jones futures up 755 points. Yesterday, down 2,000. I couldn't tell you, first of all, where we're going to open in 10 minutes, much less where we're going to be at noon today or where we're going to be at the close or where we're going to open tomorrow. That's what volatility does. You have no idea. It's a guess. Now, we do get to points where it's almost like a rubber band. I look at volatility index, I look at the put-call ratio as like a rubber band. You just pull it back, you pull it back, you pull it back, and at some point, you're going to let go. And when you do, it is going to snap back, and it's going to snap back hard, and it's going to hurt if you're on the wrong side of it. So I think, that's the thing you have to watch when we're in an environment like this. So let's look. Here's the S&P 500. This was back in 2009. So this was through March of 2009. You can see the big drops here. You look at volatility. We got up to 80, 90. Yesterday hit 62. We still haven't gotten to the fear back in 2008. And personally, I don't think we're going to get that high. Although the media can be ruthless, and we may see headlines continuing for quite some time. I don't know. I don't have a crystal ball. But what I can tell you is that the VIX we saw yesterday is 62 is the second highest ever. This was the only period in history where we've seen the VIX higher. So there's a lot of fear out there. When we move on to 2011 and we look at this drop, now I've got this set up in with Fibonacci. So we got a big drop. We're held 50 to 61.8%. These two Fibonacci retracement levels, you can see all of these tops coming in this zone before we went back down, got a double bottom, actually broke down a little bit below that prior low, and then we took back off to the upside. VIX got up to around 50, just below 50 back then. 2015 into 2016. Here was the August drop in 2015. We rally right back up to that 61.8%. A couple of these rallies topped out at about 50% retracement. Then we go back down, double bottom, and then we move higher. End of beginning of 2016, we actually went down just a little bit lower than these prior lows. But on the bottom, we rally back up 50%. We go back down, double bottom, and then we go higher. VIX got up to 52.5 back in August of 2015. Now, we barely made the breakdown below that low, so that's probably why the VIX didn't get much higher than low 30s back in the beginning of 2016. The fear just wasn't there, and we quickly recovered, and we never broke back down below that low, so that certainly helped. 2018, February and March was the only period where we saw the bounce go up above that Fibonacci 61.8% level. So we got close, turned around, went right back down, and here was your double bottom, and then we're back up again. In October, we moved down, bounced back up 61.8, come back down again, actually had another move up into the 50, just above 50% retracement, double bottom, and right here we had just broken down, and this was December. Literally, we were testing this low, and that's when the Fed raised rates. I'm not going to get into the Fed. I think they just added to the problem back in fourth quarter of 2018, and I think single-handedly took the market down here. But we bounced back, and the rest is history there. So that brings us to where we are right now. So look at the S&P 500, the big drop, the 50% retracement, and now when we look at the current, you can see we've actually went down and we broke below. Now, I think we're gonna have to see if we can get back up through this 2850, 2875 area. That's going to be the first big test for the market to see if we can get back up above that level. That was a little bit of support back in here, August, September, and October. So that's going to be a key technical level to watch as we start to rally. The other thing I wanted to point out is on the equity-only put-call ratio. When we were going higher, you can see that the 5-day moving average of the equity-only put-call ratio, dollar CPCE, was down around this 40.47 level. We bounced up. The S&P was still high, and then, of course, we had the big drop. The drop occurred. Here was the move. So here we saw the market moving down. This was a week later. So we were very complacent. We moved down. We saw this moving up. And so I put these question marks here. How low are we going to go on the S&P? And when are we going to get the equity-only put-call ratio to get up to this area? Take a look at where we are now. This is a live chart. Now we're up into areas where major bottoms have formed. And look, I was thinking, okay, maybe we go back down to 3,000. Well, we've gone even lower. There's a good chance that we are probably at or very close to a major bottom. So something to think about as we go forward. All right, earnings, and I'm going to go through just a couple of these very quickly. In terms of earnings, and there weren't really any big numbers or big reports. I want to talk first about Dick's, DKS. This is Dick's Sporting Goods. They came out, they did beat on their bottom line. The stock's up 10% in pre-market. A couple of nice hollow candles the last couple of days. I would watch maybe this 20-day moving average to see if we can get through. The other stock that I wanted to mention from earnings is Stitch Fix. Stitch Fix is down 31% after reporting earnings. They beat 11 cents versus 6 cents. But this is an illustration of what happens when the market is looking forward and you lower your guidance. Stitch Fix cut their Q2 and fiscal year 20 revenues fairly significantly. And the market is saying, well, we're not a fan, down 31% in pre-market today. All right, upgrades, downgrades. Let's go through just a couple of these real quick. ATVI. This is Activision Blizzard getting an upgrade today. I want to point out something because I'm going to do this in the 3 you must see here in just a minute as well. Here's the accumulation distribution. Normally, when a stock goes down, the accumulation distribution goes down with it. Here's a stock that's been going down since middle of February, but accumulation distribution is going up. And this gets back to those gaps that I've been talking about. So when you gap down, but then you see buying during the day, accumulation distribution looks at that as a positive. If you close in the top half of your candle. On balance volume, if you're down for the day from the prior day, it doesn't matter where you close on your candle, it's a negative. That's the difference between these two indicators. I like the accumulation distribution, especially in a real volatile market like this, because I'm looking at this chart, and from a candlestick perspective, I'm seeing a lot of hollow candles. In other words, stock's gapping down because of all the fear, but there's plenty of buyers during the day to buy this stock. So I like this upgrade. I think this is a stock that's been getting beaten up during the gaps, but accumulation distribution tells me this is a pretty good stock. And then you see a stock like CCL, Carnival, being downgraded today. Really? Stock goes from $52 to $21, and you're going to come out and downgrade them? I think they've been downgraded enough on their chart. But who knows where the bottom is on these cruise lines. Carnival did get downgraded. Stock's up 9% pre-market. So the market just says enough's enough in the near term. Now, I wouldn't trust it going forward, but we'll see. All right, 3 you must see. I'll go through these pretty quickly. First, I'm going to give you some charts that I think look good. And I'm going to talk a little bit about them from a accumulation distribution. So I'm going to get rid of the RSI, and I'll just show you these charts pretty quickly here. So Tesla. So Tesla's coming down, right? Well, here's a low, here's a low, here's a low. 3 lower lows, and I see just the accumulation distribution going sideways. I actually like Tesla. I think the sell-off's an opportunity. When it was at 900, everybody wants a pullback. Then it pulls back. Nobody wants it. Next one, DXCM. Stock gaps up with earnings. Been pulling back, but it's been like pulling teeth to get it to pull back. But as it pulls back, look at the accumulation distribution, setting new highs. That makes you go, hmm. And then finally, RNG. This is Ring Central. So RNG going down all the way to the 50-day moving average. PPO has been in rapid decline. Horrible stock over the last couple of weeks, right? I mean, it was over 250. Yesterday was 190 and change. I mean, it's been awful. Volume trends look really strong to me. And now you've got the accumulation distribution setting new highs at opening in March. And even with this huge pullback here in March, the accumulation distribution turning up, I think today could break out again if it has a good day. So I just wanted to point these out because accumulation distribution isn't an indicator that I typically look at, but in a market like this with the huge gap downs, I think you got to at least be paying attention to it. All right, everybody have a great day, and I will be back tomorrow at Earnings Beats. Happy trading.